Joining us now from the event, Goldman Sachs Managing Director Eric Sheridan, whose top picks include Amazon, Uber, and Meta. Eric, thanks for being with us. We'll be over at the Palace Hotel this afternoon also in the next few days. With that setup, inflation expectations, they are cooling. We're coming off a pretty good week where the NASDAQ moved higher again today. Where do we go from here?
Well, I think we hit peak fear in a lot of ways through most of the summer months. I mean, most of my investor conversations are much more bearish than bullish. I think coming out of August and into September, we've seen, at least in my sector, a little bit of reason for optimism. E-commerce trends are accelerating as we move past the tough comps of the pandemic. Digital advertising trends, which were very much feared in June and July, that there would be a much more pronounced macroeconomic slowdown by now, are coming in a little bit better than expected. We had Snap pre-announced positive just 10 days ago at the end of August. So I think we went right to peak fear. We've had a little bit of a reprieve in terms of some of the data points we've heard from companies. And I think a lot of investors are here at our conference this week in San Francisco to check in on consumer demand, enterprise demand, and then more importantly, a lot of the potential turnaround stories for 2023 as well.
At the same time, Eric, no expectations have changed. They're only increasing for a 75-point basis interest rate hike at the next Fed meeting. And, Fed Chair Powell was talking about more pain. We've also talked to a number of those enterprise companies, some of them who are seeing these lengthening sales cycle. What makes you confident that there's not another shoe to drop here?
Well, there could be pockets where there are other shoes to drop. I think our approach and what we've been advocating, really, frankly, going back over the last 6-9 months, is focus on profitable tech, focus on industry leaders, focus on pockets of the market where you can actually value them on GAAP operating income and GAAP earnings per share, and factor in stock-based compensation. Look for rising profit margin narratives, not falling profit margin narratives. Amazon and Uber, which are among my two top picks, and Dara Khosrowshahi from Uber will be here in a short time for a fireside chat. That's an example where profit margins are rising, not falling, against a very strong, solid demand environment. I think those are the things you want to look for. When you look at maybe non-profitable tech, we find less investor interest there and less risk appetite. So I think the world is somewhat shifting based on end demand trends and also valuation dynamics.
Eric, I get it that there's less investor appetite for non-profitable tech, but could that be wrong? It seems like inflation expectations are slowing down because demand overall is slowing down. We don't know how much of a slowdown that's going to be. It could be worse than the inflation scare, depending on how much it slows down. But it seems like some of these innovative younger companies actually have really impressive net revenue retention rates. They have really impressive technology moats. And even though the stocks might not be popular for a while, they might still have strong growth trajectories, right?
100%, John. And I think implicit in your question is sort of the dynamic investors find themselves with. There's a lot of uncertainty. Nobody really knows what the interest rate curve is going to look like over the next 6 months. Nobody really knows about inflation. There are now some more optimistic signs that we're coming towards the end of this cycle than the beginning of this cycle, but the visibility into that remains relatively low. Typically, when you look at putting a revenue multiple on a non-profitable tech company, no matter how aspirational their tech is, and there are plenty of great, interesting, innovative companies out there, most investors will only do that when they're putting risk into their portfolios and they're applying more visibility into the broader macro environment. We are in a better position maybe now than we were 6 months ago, but I wouldn't say we're out of the woods just yet.
And Eric, you're talking about improving margins for some of these companies. How do you factor in stock-based compensation with companies that are now producing free cash flow or looking more profitable?
Well, I think there's a couple points to make on this. Back in 2016, my team and I injected the idea that stock-based comp needed to be treated like an expense, and I sort of got laughed out of the room by a lot of investors. And here we are, half a decade later, and now it's becoming more dogma that you have to factor it in. And I think you're even hearing it from the companies. You are hearing the largest companies in the world in tech allocating cash on their balance sheet to buybacks to, at a minimum, offset stock-based compensation, including some of the biggest growth companies in the world. So I think even the companies themselves want investors looking at GAAP net income. They're allocating capital against reducing the dilutive impact of stock-based comp. And I think it now factors in towards the top of mind for almost every either growth or value investor that I talk to on the global scale.
Eric, thanks so much. Looking forward to the conference.